Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi guys, this is Aditya Vora here. Hope you guys are doing well. You know, every time you meet someone who wants to build a long-term portfolio, they will tell you to suggest one or two EV stocks. And whenever such a question is asked to me, I tell them I can give you names of 5 companies making EVs, but I have no idea about the returns you will generate out of them, or worst case, out of those 5 companies, 1 or 2 may not even be solvent 5 years down the line. Now, if you look at the way the world is progressing with EVs, I am sure by the above answers, you would be considering me in very low regard. Let me explain on why I am averse to buying EV manufacturers. While there is no second opinion that EV penetration is going to rise 10 times in less than 10 years, the problem lies in investing in pure play EV stocks. What is good for the customer need not be good for investors, right? There must be a reason why players like Bajaj, Hero, Honda and Maruti are going slow when it comes to electric vehicles. The competitive intensity in the EV sector is so high that having profitable growth is far from reality, at least in the near and medium term. Say, even if we find a player which makes money out of making EVs and has limited competition, the valuation is insane. So in that case, why not play the auto cycle without the fear of EVs and the uncertainty around predicting which company will emerge as a winner while which company will get hit? The answer to the above question is to buy auto ancillary stocks. Auto ancillary stocks which are EV agnostic. This way, your risk is zero when it comes to technological disruption. So friends, in this video, I will be discussing one stock which should be part of your portfolio irrespective of what happens to the EV revolution. This way, you play the domestic auto cycle which in my opinion has just begun, and at the same time, you have exposure to the global EV cycle which in my opinion is at least 10 years ahead of India. And not to forget, you also get to play the domestic EV story without the risk of competition and price wars. The stock which I am going to talk about is the flagship company of the RP Sanjeev Goenka Group, which has companies like FirstSource, the IT company, CSE, the power distribution company, music streaming and repository company Saregama, and not to forget, they are the owners of Spencer Retail and Nature's Basket. This company which I am going to talk about is not well known as it isn't a direct consumer facing company. However, the prospects and financials make it a company to definitely keep in the watch list. This company ticks almost all the boxes in my checklist. It is completely EV agnostic, and that is the reason you can play the domestic as well as the global auto cycle without any risk from EVs. The company I am talking about is PCBL Limited, or erstwhile Philips Carbon Black Limited. PCBL is India's largest carbon black manufacturer and 7th largest globally. Carbon black is a chemical which is used in making a tire. So say, for simplicity, if the cost of making a tire is rupees 100, rupees 13 to 15 is the cost of carbon black in it. Apart from tires, carbon black is used in various industries ranging from pipes, cables, fibers, inks, paints and coatings to complex processes like injection moldings too. In fact, while tire is a commodity, carbon black when used in specialty chemicals and performance chemicals I just spoke about is much more profitable and has a higher realization and margins. Coming back to PCBL, it has a capacity of 6,03,000 tons per annum, while its nearest competitor is at half the capacity. There are barely 4 players in the organized sector, while PCBL is a market leader in the domestic carbon black segment with about 40% market share. Revenues from the tire segment account for 65% of PCBL, while the high margin performance and specialty chemicals account for 27% and 8% respectively. The company exports 30% of its revenues to more than 40 countries. So there are 5 reasons why I am positive about this stock. The first and the most important reason being, this company is the biggest beneficiary in the auto upcycle. Now, PCBL is a proxy play on the auto segment. As we all know, the auto segment has been down in the dumps over the past 5 to 6 years. If you see the sales volumes numbers, currently they have started to look encouraging. Apart from the new car sales, there is a massive replacement demand which is expected to come over the next 2 to 3 years. So the tire companies will benefit from the new sales as well as the replacement demand. PCBL is a direct play on the tire demand, while the tire demand is a direct play on the auto sales. I see a big positive for both of them. Now moving to the second reason, this company is moving up the value chain. That is, performance and specialty chemicals are likely to boost margins. While tires are a commodity, the real juice is in the performance chemicals and specialty chemicals where the margins are way higher. The share of specialty chemicals has jumped from a minuscule 1% in FY15 to 8% currently. The EBITDA margin enjoyed by the specialty segment is anywhere between 16 to 18% as against the company average of 12 to 14%. Now with 60% of revenues coming from export market in the specialty segment, I think the specialty and performance segment is going to boost margins going forward. To increase the share of specialty segment, the company's new specialty plant will come on stream by end of this financial year. You know, the incremental capacity is 55% of the current capacity in the specialty chemical segment. Now my third reason for recommending this stock is massive capex lined up in the tire industry. The tire industry, which was plagued with lower utilization levels on account of weaker auto demand, has lined up a total capex of 20,000 crores over the next 3 to 5 years. This shows the optimism in the auto industry. In fact, if you look at PCBL itself, the company has lined up capex of rupees 1,200 crores over the next 3 years, which will substantially boost its capacity in both the carbon black segment, where it is the market leader, and specialty black segment, which will boost realizations per ton along with margins. Now my fourth reason is that Chinese imports are on the decline. Now let us understand some basics. There are two ways to produce carbon black. One is the CBO, which is a byproduct from coke during steel production. This method is used in China, while players in other parts of the world, including India, use the CBFS, which is a crude derivative. The coal tar, which is the CBO used by Chinese players, is polluting and hazardous. Also, coal tar is used in many other industries like naphthalene too. So in short, if CBO prices are higher, Chinese imports become less competitive. Currently, if you look at the CBO prices, they are 80% higher than the CBF prices, making it uncompetitive to import carbon black from China. Now my final point for contention of this company is valuations. For a company which generates a return on equity and a return on capital employed of 18 to 20% and is expected to rise going forward due to the increasing share of specialty chemicals, its current valuation of 11 times price to earnings is fairly reasonable. While I understand this is a commodity, but PCBL definitely deserves a 13 to 14 time multiple at least. I mean, it is India's largest carbon black player with very low debt to equity ratio. My logic for talking about this company is very simple. While everybody talks about Auto Cycle and how depressed it has been over the past 5 to 6 years, very few people focus on companies like PCBL who will not only thrive with the pickup in Auto Cycle but is also a play on specialty chemical segment, which is likely to be at least 15% of the company's sales going forward from the current 9%. So basically, when you buy PCBL, you play on the domestic auto cycle plus the global auto cycle plus the domestic and global high margin performance and specialty segment, which is currently 35% of revenues, and going forward with the way capacity expansion is happening is likely to be at least 40% in the coming years. Lastly, one more solace is that you don't have to think whether Ola scooters will beat Bajaj or Hero in market share, or whether Tata Motors will emerge a winner in the passenger EV market, or which company will win the cat and mouse game. Whichever company wins, they are going to use tires, and it doesn't matter whether they use tires of Seat or Apollo or any other company. PCBL will supply carbon black to all the tire companies, which will be used in all the cars, passenger vehicles, two-wheelers and CVs. So friends, do keep this interesting stock in your watch list and do let me know if you have any queries. Thank you for watching my video and please like and comment if you found this insightful. Thank you.